Do you have only $1,000 to invest? Here's the smart way to do it. I'm Charles Regan. Let's look into it. The world of investing can seem daunting, especially if you're new to it. So the first rule to remember is that you should never invest more than you can afford to lose. However, with careful financial planning, you should be able to figure out a percentage that you can safely put aside for investing every month. That could be $50, that could be $500, it'll depend on you. Something is always better than nothing. Try to put aside a certain amount each month, no matter how small. Let's assume for this video that you've got $1,000 put aside for investing. What next? You have the biggest potential to make a lot of money by investing in individual stocks. What is a stock? A stock is a small piece of ownership in a company. When the valuation of the company goes up, your stock price goes up. A company's stock price valuation is based on many different factors, like the company's financial performance, its future growth prospects, and overall market conditions. Some stocks pay their investors dividends. Dividends are payments that some companies pay to people who own their stock. Not all stocks pay dividends though. It's usually just the more established companies, like Microsoft, Apple, or Coca-Cola, to name a few. Earning dividends from holding stocks is a great way to earn passive income. You can even reinvest the money you earn, meaning that your stockholder will be slightly bigger. And then that will mean you'll earn a slightly higher dividend next time because of your slightly bigger stock. This process is called compound interest. It compounds over time. The other way to earn money from stocks is through buying them at a certain price, waiting for the price to go up, and then selling them. Assuming stable market growth, the longer you wait to sell, the more profit you could potentially make. However, you never truly know if the stock price is going to rise or fall. So it's all about choosing the right stock and the right time to sell. You can buy stocks through trading platforms like Robinhood, Moomoo or Webull, or in the UK Trading 212 or Hargreaves Lansdown. Buying the right stock at the right time could potentially give you astronomical returns. For example, if you bought $1,000 worth of Apple stock in 2003, just before the release of the iPhone, today that would be worth over $200,000, and it's still going up. How do you know which stocks are going to go big? Well, there's plenty of expert investors out there who you can follow and take their advice. But just remember that not all of them are going to be correct. So it's important to choose carefully whose advice you're going to trust, and always do your own research as well. Look for macroeconomic trends that are likely to take off in the future. For example, back in 2019, you might have started to hear that powerful AI was on the horizon. With just a little bit of research, you could have found out that Nvidia was the leading AI hardware company, which might have led you to think they could be worth investing in. If you'd invested $1,000 in Nvidia stock in January 2019, today it would be worth approximately $38,000. Individual stocks can give you a big reward, but they're also a risk because you never know if the stock is going to tank. A less risky option is to diversify your investment through a simple index fund. What is an index fund? Think of it like a bag of lots of different stocks. So an S&P 500 index fund is a bag of all the stocks on the S&P 500. The S&P 500 is the 500 largest publicly traded companies in the US. So instead of investing in just one, 2 or 3 of these companies, you're investing in all of them at the same time. Even though short-term losses are possible, the S&P 500 has historically trended upwards for decades. And the icing on the cake is that index funds usually have very low fees attached, since they're usually run by algorithms instead of fund managers. The world's most successful investor, Warren Buffett, is famously a huge proponent of index funds. He once placed a $1 million bet that an S&P 500 index fund would outperform a professionally picked fund over a 10-year period. And what do you know? He was right. There's loads to choose from. You can invest in sector-specific funds. You can also find index funds for specific regions or countries, even things like the sustainability sector. The world is your oyster. Your next option is to put your money in an investment fund. The difference between an investment fund and an index fund is that an investment fund is usually actively managed by professional fund managers, as opposed to index funds, which are always passively managed by algorithms. Investment funds aim to outperform the market, whereas index funds aim to match the performance of the market. Investment funds tend to have higher fees associated with them, since they require the work of managers to research investments and buy and sell stocks at the right time. Investment funds are higher risk than index funds. Because they're trying to outperform the market, that means they can potentially underperform as well. So, where should you put your stock, investment fund or index fund? The best place for them is inside what's known as a ROTH IRA, or in the UK, it's called an ISA. Let's call them containers for your investments. By putting your investment inside this container, the government can't tax you on it. In fact, they're so good, the government will only let you invest a certain amount every year. Some of the brokers I like to use for these are Charles Schwab, Fidelity and Vanguard. All you have to do is to create an account, deposit some money, and you're good to go. Your next option is a high-interest savings account. Putting some of your money in a high-interest savings account can be useful because you'll have easy access to it, and that could be a lifesaver if an unexpected emergency comes up. We call this having money that's liquid. It's not tied up in assets or investment, so you can easily withdraw it whenever you need to. It can also be useful to have easy access to your cash in case a sudden investment opportunity comes up. For example, if there's a sudden market crash and you want to take advantage of cheap stock prices. This happened during January 2020 as everyone panicked because of a certain virus. The market fell dramatically, but then it quickly bounced back and even kept on growing, so you could have taken advantage of that sudden dip and made a lot of money. Some of the savings accounts I recommend are Citibank, Ali Bank and Marcus by Goldman Sachs. Next up is gold. This can be a very safe investment because gold is much more resilient to inflation than the US dollar. The reason gold holds its value is because it can't be artificially manufactured and it lasts for thousands of years. It doesn't rust, corrode or tarnish over time. It's so rare that all the gold that has ever been mined in human history would fit into a cube with size of about 21 meters. How crazy is that? Gold has been used as currency by human beings for over 5,000 years, so I wouldn't bet on it going out of fashion anytime soon. We can think of gold as a long-term store of value against inflation. It won't necessarily grow your money exponentially, but it's a safe place to put it, where your money will hold its worth in the long run. You can invest in gold through a gold ETF or ETC, which is like an investment fund for gold, meaning that your investment in gold will be well diversified in the gold industry as a whole. This way, you'll be able to buy gold at its true value and you'll always have the option to sell it almost instantly. You can find a gold ETF through a broker app like Robinhood in the USA or Trading 212 in the UK. Here's the next investing option, a real estate investment trust or a REIT. This is like an investment fund for real estate. It would be like 500 people each investing their $1,000 to collectively buy a $500,000 property. Each of those investors will then benefit from the income this property produces through rent. And this doesn't just stop at homes. You could own part of a warehouse, a shopping centre, a hotel, even a hospital. REITs are required to pass on 90% of all profits to investors, and over a 10-year span, REITs were seen to outperform the S&P 500. They showed an average return of 10%. Next up is something I'm sure you're all interested in, cryptocurrency. If you jumped onto this early, you could have won big. Let's look at the numbers. If you'd bought $1,000 worth of Bitcoin in 2014 Today, that will be worth a whopping $270,000. And if that blows your mind, wait for this. If you bought $1,000 of Bitcoin in 2009, today that will be worth $109 billion. That's right, billion. That means if you'd invested just $1 in Bitcoin in 2009, you'd have $103 million. Not bad for a $1 investment. Nobody really knows what's going to happen to cryptocurrency in the future. It seems to have stabilised somewhat, but it still fluctuates quite dramatically compared to other investment types. I recommend buying some as part of a diversified portfolio. It's never good to have all your eggs in one basket, and you don't want to be left with nothing if it goes completely to zero. The trick is to keep a lookout for any investment opportunity that you think could be the next Bitcoin, the next Microsoft, or the next Apple 10 or 20 years from now, and then investing a small amount in it, an amount that you could afford to lose if your investment doesn't end up paying off. But it's tricky, as you never really know what's going to take off in the future. But that's just the game of investing. If you want my advice, I'd play it safe and stick to index funds or investment funds. Don't try to be a genius and beat the market. You don't want to be a gambler, you want to be a safe, smart investor. And now, finally, I'm going to tell you what I think is the best investment for your $1,000. It's investing in yourself. I know that might not be what you want to hear, but it's true. Investing in yourself, in your own education and development, will get you by far the best returns in the long run. You've heard the old phrase, give a man a fish and he eats for a day, teach a man to fish and he eats for life. Well, it's the same principle. By investing in your own skills, you increase your own earning power. You could invest in yourself by taking an online course or paying for a few sessions with a business coach. Imagine just learning the skill of sales. The amount of revenue you could generate from that skill alone could be colossal. Even just learning financial literacy, as you're doing right now by watching this video, will have a hugely positive impact on your financial life over time. Maybe you invest in a gym membership, which will give you more energy and vitality to attack your goals. Yes, that counts as investing in yourself too. Investing in yourself is never a bad investment, and it always delivers outsized returns. So there you have it. Those are my smartest ways to invest $1,000. Please like and subscribe if you found this video helpful, and let me know in the comments where you're planning to invest your $1,000. Thanks for your time. See you on the next one.